Right. So thank you everyone for joining. SPACs are really a fashion today in the financial markets across the world. Their kind of amount of capital that they've raised is very significant over the last 1 year or so. And today we have Nishith Desai himself, who's there, and Dhruv, who needs no introduction. Dhruv is the founder of Yatra.com, and Nishchal, who's also a part of the Nishith Desai's team, and he's been actively running the SPAC mandate on an acquisition side. Just to kick this off, I mean, keep it very simple, so that everyone gets the basics right. SPAC basically stands for a special purpose acquisition company. So consider that as a listed shell company, which has some capital in it, deployed by various types of investors, and which is looking to make acquisitions, acquire majority stakes, and roll up these companies into the listed vehicle. So in a way, it's a combination of a reverse merger into a listed company and a pipe transaction. So that's the simplest way for me to define it. I did one way back in 2007, but a lot has changed since then. So let me start with Nishith, Nishith Desai himself. Can you throw some light, Nishith, on facts and what is going on in that world for all of us?
Sorry, I'm just trying. Yeah, I think I don't think I need to too much. Everybody knows that there is SPAC is a flavor not of the month, but I think a few years now, and so much is happening in the SPAC regime. In fact, we began to work on that about 4 years ago. Nishchal, and started working on that, and when it came to do one of the major ones in India. And there are a lot of issues in the context of India. And now, this has become a tool to raise capital and be assured of the capital in the fastest possible time. So maybe let me not take too much time at the moment. I think Nishchal is going to speak a little bit about, preliminaries. So he has, been leading a SPAC team, and it would be wonderful to hear from him. So, but welcome everybody. It's very exciting. I think one interesting thing we saw here in the news was that I think it's just not about the money, the enterprise value, maybe 8 billion and market cap 4, whatever it is. But more important than that, I think that these are increased recognition for the sustainability and value for impact, I think. And I would actually like some point in time we discussed that every business you are in, we should try to see, does it add, does it create an impact, and that those ones will begin to command better valuation, better, future. And that's where the real game is. If you ask me the underlying theme in this particular deal, and as I see globally as well. So I think, and at one point of time, impact was a separate class, but now every business has to be creating some impact, also show the impact, communicate the value, and all even LPs and everybody is looking at. Of course, Dhruv would also confirm that. But if I may just ask Nishchal, why don't you start so we can, I don't need to spend too much time on preliminaries, but we can take it forward.
Sure.
Nishchal.
Sure. So, Ashish, if I may, I was planning to cover 2 questions. One is how does a SPAC structure work? And second is why is there a mad rush for SPAC for Indian businesses of late? So if that's okay, I can take those 2 questions.
Yes, please go ahead, Nishchal.
Okay. So quickly on the SPAC structure. So SPACs are basically, as Ashish mentioned, special purpose acquisition companies, also known as blank check companies. The way this works is the founders typically float a SPAC, and based on the track record of the founder, the investors invest in the SPAC. Now, at the time when the investors invest in the SPAC, there is no business in the SPAC, and which is why it is called a shell company. Sorry, Nishith, can you just put your phone on mute?
Oh, my apologies.
No problem. So the investors put their money in the SPAC. SPAC does not have its own business when it is when the investors invest in the SPAC and when the SPAC gets listed. The SPAC founders have about 18 to 24 months period of time to identify a target within which within that 18 to 24 month period, the SPAC targets needs to be identified. And when the target is identified and the transaction takes place, it is called a de-SPAC transaction. So there are two layers. First is the SPAC transaction, which is when the SPAC is set up, the investors put in their money, the SPAC gets listed on NASDAQ or NYSE, and the funds which are received by the SPAC from the investors are kept in a separate trust fund account. So the funds are raised even before the target is identified, and that's the beauty of SPAC. And since there is no target at the time when the SPAC initially gets listed, SEC does not spend too much time in clearing the docs for the SPAC because there's nothing in the SPAC. So what to look at? It's most of the times the documents are in skeleton form, standard format, and SEC does not raise too many queries on the SPAC documents. So this is the first layer. Now within the first layer, what is also important is how does the SPAC structure work? So typically you will have public shareholders in a SPAC and the founder shareholders. The public shareholders typically get Class A shares and public warrants. The founder shareholders get Class B or what they call Class F shares sometimes and private warrants. So typically 4 types of instruments are there. The beauty of this structure for the founders of the SPAC is that founders need to contribute only typically $25,000 to the SPAC, against which they get almost 20% of the stock of the SPAC, which means that if there is a $500 million SPAC, just by contributing $25,000, $100 million worth of stock is received by the founders against that $25,000 investment. And which is why SPACs are very lucrative for the founders of the SPAC, and which is why the founders always want to ensure that they get into a de-SPAC transaction so that they get that 20% stock at a later date, so that when the SPAC is successful. So even before these shares and warrants are issued, there is a first concept of SPAC is there are units which are issued to the holders, and then there are based on SEC filings after 52 days of the prospectus for SPAC being filed with SEC. The units after that get split between the shares and warrants to public shareholders and founder shareholders. The warrants, typically all the shares issued by the SPAC have a face value of $10. The warrants typically have a face value of $11.50. And the warrants are actually part of the SPAC structure to give an upside to the shareholders, so that as and when the SPAC enters into a de-SPAC transaction and the shares of the listed entity get listed, the shares of the SPAC get listed, at that time, if let's say the value of the shares is let's say $15 or $18, then by paying $11.50, the public shareholders can get the warrants converted into equity and they make profit out of that. So this is how the SPAC model works from a structure perspective. The second stage is the de-SPAC transaction. Now, what happens in a de-SPAC transaction is founders.
Should we cover that in the second half? There may be some.
No problem. No problem.
I have some questions just to clarify that. The amount committed by the investors is kept in an escrow account, right?
Yeah, it's called a trust fund account. Yeah.
The trust fund account, and you can't use it until you go through the de-SPACing process.
That's
which
correct.
Shareholder approval for doing the reverse merger, right?
Correct.
So come to that leg of the transaction. But just a few questions on it, just so that everyone understands this complexity of founder units, Class B, Class A shares and warrants. Let's say 100 million is raised from external investors, right? Uh, what is the ratio of warrants to shares typically these days?
So typically, it is either one half or one third to one share. That's the typical model which is there in the US PACs, which is where what they say, the one that we did for Renew Transaction RMG SPAC, which was floated by Riverside Management Group, that had a one third warrant to one share ratio, which means that if you want one warrant, then you have to buy 3 units. One unit is equal to one share and one third warrant. So 3 units is equal to 3 shares and one warrant. And only full warrants are tradable. You can't trade fractional warrants.
Yeah, so basically, if they're raising 100 million SPAC, if they have raised 100 million SPAC, then if you take that uh, one warrant for 2 shares as a ratio, another 50 million is potentially available to the blank check company for if the unit holders subscribe to the warrants, right? So it could be potentially dilutive if you after the investment, right? In addition to that, can you also you said about 20% is the norm today in terms
Yeah,
of
for the
uh,
founders.
so that's the addition dilution that will potentially take place, right?
Correct. So it's the kind of a promote for the founders that against $25,000, they are getting 20%. Although recently, although the largest pack that was raised by Bill Ackman of $4 billion, he has waived this 20% promote concept in his pack. And he wants to be at the same level as other public shareholders. So slowly things are changing. But yeah, as of now, the concept is that.
Got it. And one last question on the structure. This is basically listed in the US, right? Mostly in NASDAQ and NYC, right?
That's correct. That's correct.
Great. Dhruv, you want to add any nuances to the structure itself? I know you are very familiar with it since you have
Sure.
gone through the process.
Yeah, so a couple of things on this, just clarifying. So founders will typically, have a 20%, let's say, founder promote, but that is the part which is the most open to negotiation. So the closer the SPAC is to end of life, so typically SPACs will have, let's say, an 18 to 24-month period, and the closer the SPAC is to end of life, the more likely it is that you will have some leverage in terms of negotiating that down with the founders. The founders have to put in a bit more than $25,000 of capital. So typically what will happen is a SPAC that you raised, right? So in the US, investment banking fees are 7%. So the way the structure gets set up is that the founders have to pay upfront 50% of the banking fees. So if you're raising, let's say, $100 million SPAC, you have to pay 3.75 million, and then you have to pick up at least half the legal fees. So that's another, let's say, million or 1.25 million. So for 100 million SPAC, as a general rule of thumb, as a founder, you need to put in $5 million and not $25,000. So just clarifying that in terms of what goes in, and then the balance of the money gets paid out by the company when the deal gets done. So the bankers and the lawyers get the rest of the money when the deal gets done. See, the structure of the SPAC, the way it works is that anytime cost of capital is low and interest rates are low, money will flow into SPACs. Because the person who is investing in the SPAC typically, so there is a bit of a rush right now. So leave that 3-month period, 4-month period aside, or 6-month period aside. But typically are fixed income arbitrage guys. So a fixed income arb guy in a low interest regime is putting money into a trust account and getting warrants in return. His play is only the warrants. So what we need to understand is as you go through the SPAC and the de-SPACing process, just the fact that the company has money in it does not mean that the money will stay when the trade happens. All the guys who put the money in will still, are likely to vote yes for the deal because that's what provides value and upside to the warrant, but want their cash out. So as a business, then you have to be on the road, meeting new investors and getting organic capital coming into your business. If you're not able to do that, it then creates a lot of trading idiosyncrasies where typically, the minute you go public, because it's a fixed income ARC fund which is invested and their mandate does not allow them to hold equities, they will dump the stock and exit, right? So that's the other thing to just think about, that, that's how structurally you have to take into account that just because the shell is there and the shell shows some capital in it, that is not capital which will necessarily stay with you.
Yeah, that's a very, very crucial point, and I wanted to pick that up in the destacking part. But that's a huge point because ultimately, for a listed company, you want to have a stable and a upward sloping share price. You do, and you want therefore a mix of shareholders uh, who are potentially see the longer term value creation of your company. If you have, I mean, uh, you're absolutely right. There are lots of hedge funds and fixed income guys who are doing this, which means that the first thing to look for when identifying a SPAC to merge into is what is the quality of investors backing it. I believe there are some changes these days because a lot
That
of
is the big change, sorry, Ashish, in the market which has happened. So you've got today big PE funds. So you've got Bain, you've got Wilbur Ross, you've got Apex, right? So you've got people like them coming in and putting out SPACs. So those SPACs, you can think of those as, let's say, a single transaction private equity fund, right? The other thing which is happening is that more and more pipes of organic investors are coming in. So in the Renew Power deal, for example, you have Chamath who's coming in as a long-term investor. So in our deal, we had Macquarie who came in as a long-term investor, right? So I think that's the kind of other change which is happening compared to where it was. So identification of the SPAC, what's happening today is that there is so much noise. I mean, in the last 6 months, this might be my 15th, 20th conversation, right? In the first 4 years of going public, maybe 3 to 5 people would have spoken to me about SPACs. In the last 6 months, there are like 20 conversations I've had about SPACs. And everyone looks at SPAC as a utopian transaction, right? Or here is this company, it's just got money in it, and I'm just going to merge with it, and that's over and done with, right? And the money just flows onto our balance sheet. So there are lots of these structural issues as you go through the despacking. We'll talk about it, but I think this is a case also buyer beware.
Yeah, absolutely. I think that's the trick is in getting the nuances right in this. Otherwise, you could be burnt quite badly, both as a promoter of a SPAC, and you mentioned, Dhruv, that the 20% is up for negotiations. I've also seen many a times, in order to cast the yes vote from the investor side, many of those investors would negotiate part of the equity of the SPAC. Uh,
That's right. Yeah. Yeah.
so the you've got to really get the nuances right, otherwise you can get burnt. I think that's the message that Dhruv is giving. Uh, I mean, also the we were trying to add up the dilution. The dilution is non-trivial, right? Because you
Ashish, can I pause you here? Ashish, can you explain that promoter part? Sorry, I missed it. I probably couldn't follow it.
Yeah, no issue, Manisha. I'll try to do that, and Nishchal and Dhruv just add to this. So basically, as Nishchal said, if the total amount of uh, units sold, the value of that is about 100 million, which is 100 million SPAC, then usually 20% of that is given as founder equity, which is Class B shares, which is basically the strike price for that is very nominal. Uh, Therefore, those are kind of free shares. So that's 20% dilution. In addition to that, every unit has a share and a warrant attached to it. And a warrant, like Nishchal explained, it's a 1:2 kind of structure. So there's potentially more dilution if people exercise the warrant because you have
Ashish, I got this part. I think the part around how you can negotiate the promoter bit, I think Dhruv mentioned that. I probably...
Yeah, I can maybe explain that for you. So typically, what will happen is in a deal, this is a merger transaction, right? It's an M&A transaction. So between the SPAC founders and yourself, you're agreeing a price and a value for the business. The price and value for the business, there'll be investment bankers who would have taken the SPAC public. They will also play a role. So you'll take public comps and say, this is, let's say hypothetically, the value is 300 million. Now, the public market investors are not going to pay more than 300 million for the deal. So the share of the SPAC founders has to come out of the pre-money value of the deal. So to that extent, as an existing management team, you will take on the dilution, or as an existing company, you will take on the dilution of the shares which are there for the SPAC founders. Now, when the deal is set up, they have 20%. The SPAC has a 2-year end of life. So at the end of 2 years, they need to return the trust money in. And remember, they've put in about 5% of that capital in. So that 5% of theirs is lost. So they also then have an incentive to get a deal done. And it's more likely that they will be willing to trade on the 20 and bring it to 10, or somewhere in between, the closer you are to end of life.
All right.
Right. So that's the dilution you will take as a business.
Fine. Okay.
And similarly, if there are some larger investors controlling the SPAC, many a times there are these predatory SPAC specialists who will corner all the warrants and buy up a few shares, particularly when it's coming to end of life. They could also negotiate founder shares from you and say that in order for me to cast the yes vote, you have to give me some incentive, which comes again out of the founder kitty. Right.
I had just a couple of questions for Dhruv. So Dhruv, on the expenses side, isn't that when the public shareholders contribute to the trust fund account, certain percentage of that is carved out for expenses, maybe 2 or 3% of that amount? And second question is, even if the founders are contributing, to the expenses, as you mentioned, the banker's fee and let's say the lawyer's fees, does that amount go as a loan in the SPAC and not form part of their 20% that they get, or so that when the loan is converted, do they get more stock about 20%, or it's subsumed within the 20% shareholder?
No, typically it's within the 20. So they don't get anything extra for that capital. See, what will also happen is that people, the guys, the fixed income ARC guys, want to see the skin in the game from the founders as well, right? Otherwise, then, there is no skin in the game from their side.
Sure.
They're obligated to put in that kind of capital to at least make sure that they will then do justice to the deal.
Right. Understood.
So let's take the obvious question. I mean, in that case, it looks like it's basically a reverse merger into a listed vehicle, right? So what is in it for potential targets to consider merging with a SPAC? Why would they not just go do a reverse merger followed by a PIPE, or alternatively, why would they not do an IPO?
See, I think in terms of as a founder, and I've learned this the hard way, right? We went through this process. We've had a very torrid history because of some shareholding structures, and warrants getting complicated as we went forward. Some of the things that you pointed to, right, where people corner warrants, it creates a long short kind of strategy opportunity for people to go long on the warrant, short on the stock. So all those kind of nonsensical things can happen. But I think as a founder, you should first try and see a straight IPO. To my mind, that is the cleanest structure, especially out of India, because maybe, Nishchal can add more value to that there are a lot of tax complications as well of doing an Indian transaction, right? If you're an Indian company, if you're an overseas holdco, then you still have, the chance of doing a reverse tax merger. But if you're an Indian holdco, there are a lot more complications that come with it on the tax side. But beyond that, building trading in a stock is always a challenge. In this market, it's still easier, but in a more, normalized market, research is what drives investor interest, right? Tier one research coverage. In a SPAC, because the IPO has already happened, unlike a traditional IPO where you will have the bankers who are taking the company public providing the research, you don't have any guaranteed research coverage in the case of a SPAC. So it takes time to build that research coverage, build that investor following. So making sure that initially itself you can get the right set of investors pre-de-SPACing becomes critical. And then it's no different from a normal IPO. You're doing the full roadshows that you would typically have done in the case of an IPO. It's just that maybe you've got a bit more time. The only advantage of this is that the pricing of the deal is not dependent on market circumstances, because pricing to a certain extent is governed by transaction between two parties. So take our example. In our case, the pricing was agreed in July of 2016 with listing to happen before end of 2016. When we were on the road, two things happened. One, Trump got elected, and the next morning, India got demonetized. Now, as an Indian stock, if we were going public at that point in time, our price would have completely collapsed because no one knew what will happen on demonetization. And there was this entire question around disposable income getting sucked out of the economy and the economy slowing down, right? So for a consumption-led product like ours, that was a critical factor. But because it's a negotiated transaction between the founders of the SPAC and you, the price is settled. So that is, I think, one advantage, but that advantage comes at a big cost of dilution, which is for the founder shares. And if you are in a precarious situation where warrants get captured by people and then they have some leverage, then there can be additional cost over and above that as well. So my take typically to founders is that if you can do a straight IPO, do a straight IPO. For US entities, it's slightly different because there are no tax complications over there. Over there, the company is already public, the Czech company is public, it just acquires, and in exchange, you get shares. In India, if you were to just get shares straight in exchange, it'll immediately trigger capital gains tax. So typically, you need to ensure that your entity is the surviving entity. And to do that, you then need to follow the full SEC process of filing your financials for the last, 3 years and all of that under IFRS or under US GAAP and go through the full scrutiny of the F4. So it's as cumbersome a process. So I think it's better to just do a straight IPO if you can.
Yeah, maybe I can give some perspective.
Yeah, it's a good time to get into the de-SPACing process and what the nuances are on that. Explain that.
Yeah, maybe Ashish, I think before that, I'll just take a couple of minutes on from an Indian perspective, why there is more interest in SPAC these days. So just for the benefit of everybody, there have traditionally been 3 routes which Indian companies have for going public, right? First one is to just directly list their shares on Indian exchanges. But some of the businesses in India are not valued as well by Indian investors as compared to US investors, which is where, like for example, e-mobility, which is a very hot sector for SPAC. You won't get good valuations in India as you will get in the US, right? That's one. So if you're not getting good valuation, then the next route is to list the Indian company directly on NASDAQ or NYSE. The problem with that is Indian companies are required to list in India before ADRs, GDRs can be issued on NASDAQ or NYSE. So again, you have to list in India first, and then you can list on NASDAQ. So again, the same issue like the first one, where you have to still go ahead and list in India. Now, the third route, which is there, which has been announced by the government in March 2020, we are almost 1 year from that day. But the government has not yet come out with detailed guidelines where government is going to allow direct listing of Indian company shares on foreign exchanges. So you don't need to go to the Indian shares directly list foreign exchanges without listing on Indian exchanges. So this is something which will be very interesting as and when it happens. Having said that, as I mentioned, it's almost 1 year and nothing has come out in terms of detailed guidelines. And there are a lot of rules that need to change from an exchange control, securities law, and corporate law perspective before this becomes a reality. And typically, we have seen government has been very slow when it comes to anything to do with the capital markets in India and allowing Indian companies to list abroad. So because these three routes have not been very successful, even the IPOs, not more than 20 IPOs, as I understand, happened last year in India, right? That is why what we are seeing is an interest on SPACs, right, for Indian businesses. And one of the best structures for SPAC is if you can externalize your company to a foreign company. Then the best thing about SPAC structure is that India does not come into picture once you are able to externalize the Indian company to a foreign company, right? Because then your foreign company gets listed on NASDAQ or NYSE, and you don't have any requirements of following SEBI rules or following anything to do with exchange control for listed shares. So even if there is a route available in India to list Indian shares on the exchanges, I would still suggest that it is always better. And I'll give you a simple example. If the Indian company is listed, to issue differential class of shares, let's say to founders, you want to issue a different class of shares, to non-founders or public shareholders, you want to issue another class of shares. Those things are very complicated. SEBI comes back and says you can't treat two different shareholders, two shareholders of the same company differently. When we do something on, in case of a foreign company, let's say a UK company getting listed on NASDAQ, we can have shares with differential voting rights, we can have shares with differential economic rights, we can have golden share type of arrangement. So the flexibility which a foreign jurisdiction provides for listing abroad is substantially more than flexibility which India provides. So my sense is, and that's what I even advise my clients, is that if there is an option to flip your company abroad, do that first and try to list that company on the foreign exchanges rather than listing the Indian company directly on foreign exchanges.
I think Nishchal,
I'm sure Dhruv will agree if Yatra was not a foreign headquartered company, the challenges of listing, let's say Yatra India, would have been substantially more than what he would have faced.
Absolutely. I think that's an excellent point. The challenge that, from our perspective, what we found, and just to elaborate on our structure, we had a Cayman holdco, and then we had Singapore subsidiary and Cyprus subsidiary holding India. So it was easy for us from that perspective to do a merger at the Cayman level, where our Cayman holdco merged with the listed entity. The challenge which was there is more from a tax point of view as opposed to regulatory. Because typically what happens in a SPAC transaction is that you get shares in the SPAC. So your shareholders of the entity or your holding company will get shares in the SPAC. And the minute your shares change, the nature of security changes, it triggers a capital gains tax in India. So typically from a founder's perspective or even from an investor's perspective, everyone has the same challenge. Because the asset is substantially in India, you get triggered capital gains tax, and then you have paying or liable for capital gains tax without liquidity. Because liquidity happens only subsequently. You have lockups in place when you go public, which can range from 6 months to 12 months. So liquidity then is a challenge, whereas the tax gets triggered on day one. And the way to avoid that is to do what is called a reverse tax merger, where your holding company becomes the surviving entity, the SPAC merges back into you, and through an SEC approval process, you become the surviving entity. So it's a complex transaction which is there, but that does, find a way around the tax issue.
So Dhruv, is that how you did that with your?
Yeah.
Okay.
Yeah, because otherwise, for let's say us guys, it would have been a big challenge, right, to trigger capital gains tax and then have, on the other hand, a lockup.
Sure.
Substantial period of time.
Absolutely.
So Ashish, just a couple of points on that. It's important for the Sorry, can you hear me, Ashish?
Yeah, I can hear you, but
Yeah.
I think we've deep dive into the issues of tax. I think just explain the de-SPACing process, because that is critical before we deep dive into the nuances of what to do during such a transaction.
Sorry, was that for me or Dhruv?
Yes, for you, Nishchal.
Okay. So the de-SPACing transaction, what it means is that the SPAC identifies a target, and then either it acquires the target or the target merges with it, or the SPAC merges with the target. Now, what happens in a de-SPACing transaction is two things are important from a SPAC perspective. First is that at least 50% of the shareholders of the SPAC should approve that transaction. And again, depends on the corporate law of that jurisdiction. If it's a Cayman SPAC, then Cayman has a requirement for ordinary resolution where more than 50% shareholders should approve the de-SPAC transaction. If more than 50% shareholders approve the transaction, then the transaction goes ahead and the de-SPACing takes place. If less than 50% shareholders approve the transaction, which means more than 50 have, let's say, rejected the transaction, then the funds lying in the trust fund account get refunded back to the public shareholders. So that's the nuance with respect to the de-SPACing approval that is required from the shareholders. One other point is that the investment that the SPAC is going to make should be at least 80% of the funds sitting in the trust fund account, right? So if $100 million are sitting in the trust fund account, then at least the SPAC should be investing $80 million in the target, or as part of the de-SPAC transaction. And as Dhruv rightly mentioned, the shareholders also typically have the flexibility to even ask for their money back as part of when the de-SPAC transaction takes place, or when the approval is taken from them. And that is why the PIPE transactions are very common along with the SPAC transaction, so that from the counterparty perspective, especially the Indian founder or Indian promoter who is the counterparty to the SPAC, they want to ensure deal certainty. And one risk is always there, that what if there is substantial refund that is asked for by the public shareholders, which is why there is always a PIPE which is arranged alongside, so that even if there is a heavy refund that is demanded by the public shareholders, the PIPE investors, they fund that deficit or shortfall and ensure that there is deal certainty for the deal value.
Yeah, I mean,
so that's how the de-SPAC happens.
One of the other reasons is to bring slightly different profile of investors into the SPAC, right? Just as Dhruv mentioned. So rather than have arbitrage funds or having hedge funds as part of the shareholder base, you're also trying to bring a new class of investors, so that who are at least staying with you longer and provide the trading over a period of time. Okay, so can you want to go back to the tax point, Nishchal, that you were trying to?
Sure. Yeah, no, what I was mentioning was, as Dhruv rightly mentioned, if it's, let's say, a Indian company which does not have a holding company abroad, right? It's an Indian company and there are multiple P investors in Indian company, and there are even Indian founders, which would be the case with most of the Indian companies who have not started with a foreign holding company. I think there are a couple of parameters to identify those SPAC targets in India, right? Not all targets in India are SPAC targets, right? Because there are certain things that need to be taken care of. For example, one of the important things from a SPAC perspective is that, the Indian company should have majority foreign shareholders. Ideal would be anywhere between 50 to 80 or 90% foreign shareholders if they are there in the Indian company. Then it is easy to to externalize that Indian company first to a foreign jurisdiction. And once it is externalized to a foreign jurisdiction, that foreign jurisdiction holding entity which is set up can then list on NASDAQ. Now, capital gains would still trigger for these foreign shareholders when they swap their shares in the Indian company with, let's say, the foreign jurisdiction company, which is newly set up. But most of the foreign shareholders typically have come prior to 31st of March 2017, either through Singapore or Mauritius in the Indian company. And any capital gains earned from transfer of shares which were acquired by these Mauritius Singapore companies prior to 31st of March 2017 are exempt from tax in India. So when they swap their shares to a foreign holding company, there is no tax on them at the time of swap. So if let's say a Indian company is 90% owned by foreign shareholders and all of them are having treaty benefits, you can pretty much convert the entire structure into a foreign holding company whose 90% shareholders are the shareholders of Indian company, and then Indian company is held 90% by the foreign holding company. The challenge comes for the Indian founders or Indian promoters, because Indian founders or Indian promoters sitting in India, they are not allowed to hold shares of a foreign company, which in turn again holds shares of another Indian company. And that is what we call round tripping from a Reserve Bank of India perspective, where they don't like Indian residents owning shares of a foreign company, which in turn owns shares of an Indian company. And plus on top of that, the other issue is the tax issue which Dhruv mentioned. It's a phantom tax for the Indian promoters or founders, because if they swap their shares with, let's say, a SPAC, assuming that exchange control allows that, they still have to pay tax on day one, which no founder likes to do that. So the structure that we have designed to address that Indian founder issue is to not allow them to swap on day one, but to have a put option which these founders can have on the listed company abroad, which could be the new listed company that will be listed on NASDAQ. And as and when they want to exercise their put option, they will just exercise the option at a valuation which is the valuation of the listco at that time. So we pretty much take them to the same situation as if they are directly holding shares in the listco to the put option.
That's interesting. I think that's a pretty interesting workaround. Nishchal, you answered that question or raised that question as to what kind of companies are suitable in India for a SPAC merger. I think you mentioned one of the points was
Higher foreign shareholding.
Any other points on that? I mean, how would you think about it?
So one is, I think the ideal target would be if there is a yatra or make my trip type of structure where you already have a foreign holding company for the Indian business. That's the best structure for a SPAC, where because you don't need to touch India piece in that case. Everything happens outside India, that's the best thing to do. Second, as I mentioned, is higher foreign shareholding, where the foreign shareholders are getting treaty benefits for the swap. So that's another one. Third one, I would say, is SPACs also, and maybe Dhruv would be better placed to answer this. But typically, SPACs also need to show control or controlling interest in the Indian operating company because of the US requirement of under Investment Company Act of 1940. Where if the SPAC is not seen as controlling or operating the Indian entity, it could be considered as what, in India, we have the NBFC regulation, right? Non-banking finance company regulations. So it's an equivalent of that in the US, where if the SPAC is, let's say, holding a minority interest in the Indian business, and it does not have any business on its own, because ideally, in a SPAC structure, if you can merge the operating company with the SPAC, that's the best thing that can happen. But in India, Indian companies are not allowed to merge with foreign companies, which is where the Indian company merging with SPAC structure doesn't work, which is why SPACs have to hold shares of the Indian company. And because SPAC is only an investing entity in that case, to avoid the Investment Company Act issue of 1940, SPACs need to have at least 50% of the shares of the Indian company, or they need to figure out a structure where there is board control so that they can prove to SEC that they are not just a pure investing holding company.
I mean, if I think from a commercial standpoint, and Dhruv, you can add to this. Where it makes sense is that you are listing in the US wherever the multiples in the US public markets are higher than the multiples that you are getting in the Indian public markets, which should be ideally higher than what multiples that you get in the private market at the late stage, right? I mean, from a commercial point of view, that is the arbitrage between a US listed SPAC and a privately held company in India. Can you throw some light on that, Dhruv?
Sure. I think, there are a couple of nuances on that, Ashish. In India, um, there is a scarcity premium which is also associated today with companies with great corporate governance, with a stellar track record, clean structures, etc. And you can see that in the likes of companies like Naukri, Dixon Technologies is another one, right? India Mart is another one. So these guys are trading at kind of PE multiples or EBITDA multiples, which would be unheard of even in the US, right? So I think there is definitely a scarcity premium which is associated with it. And then there is also a question of size and scale. In the US, if you are less than $1 billion in terms of market cap, I think it's a real struggle to get investor interest, especially the right kind of investor interest, right? You get then more like, you know, hedge funds only who would typically come in. You won't have the index funds which are buying into you. You won't have the typical long only guys coming in. Whereas in India, if you're the equivalent of $1 billion company, or even let's say, $500 million company, you're a reasonable sized company in the Indian context. So you'll get enough shareholder interest and enough research coverage interest, right? So that's another thing to look out for. But while these are challenges, the big pro is that the US market is willing to look a number of years out, which India still is not. I think in India, you've still got people now, and that's a pleasant surprise that I've seen over the last maybe couple of years. Uh, Funds willing to look out 2, 3 years in terms of profitability. But if you're a kind of business which still has maybe 5 to 7 years to prove the business model, or your revenue streams haven't really, or profitability streams haven't kicked in and are likely to not kick in for the next 5 years, kind of a scenario, it'll be a struggle in India. Whereas in the US markets are much more comfortable looking 5, 7 years out from a company's perspective, as long as people understand the model and they've got similar stories which might have played out in different geographies of models like that. So I think the willingness and the ability of people over there to look at a much longer time horizon is higher over there. And that also stems from, the return on capital over there is much lower. So from that perspective, people are willing to discount it and your NPV is higher. So that's something else to think about from a value arbitrage point of view.
No, absolutely. So I think we are coming close to the top of the hour, and we've had a very intense discussion on this topic. I also want to get questions from people, but let me just summarize. And there's so much content that you have given us, Nishchal and Dhruv. Let me try to see if I can summarize some of the points before we throw it open. Basically, SPAC is a uh, acquisition vehicle listed in the US, which provides a potential exit to companies in India. So it can be seen as an alternate for exit to companies in India. Uh, and in comparison to, let's say, listing on your own or trying to list overseas, which Nishchal says is still a few years out, or just staying private, right? Uh, and uh, there are two stages of that. Once that obviously the SPAC is raised, there's a de-SPACing process which is non-trivial because it requires approval of shareholders of the SPAC. And given that we are all in India, there are a whole bunch of issues that we need to factor in. One is whether your structure is whether you're India only company or whether you have an external structure, and Nishchal indicated that there were possibilities of doing both, but obviously it's easier when if you are an external if you have externalized your structure. There's a tax issue which needs to be needs to be structured. Again, Nishchal gave some very interesting solutions on how founders can avoid tax. Uh, there are a whole bunch of commercial issues that Dhruv mentioned. Most important one being the mix of investors that you have in the SPAC, your ability to get liquidity on an ongoing basis, and for people to trade in it, which means you need research backing, and also you need to be of a certain size so that investors look at you seriously. And of course, in comparison to uh, the uh, the options you have in India, that is staying private and raising later stage private equity or buyouts or any of that kind of stuff, uh, or listing in India where there may be pockets where you get a premium. What Dhruv also mentioned was that US markets may tend to look out further out. So if you're a fast growing company, you will command potentially better multiples than you might in India. So that's like a short summary. I mean, let me just stop here and open it up for questions from anyone in this group. Do we have any questions from anyone for Nishchal and Dhruv? I mean, while you think about that, I have one question for you, Nishchal, which is what is happening on the gift city environment for SPACs? Is India also planning to start a SPAC regime?
Yeah, so this is a very recent development. Just last week, government came up with this circular on allowing Indian SPACs in Gift City. Gift City, as all of you would know, is the international financial center in Gandhinagar in Gujarat. And it's quite interesting from an exchange control perspective. It is considered as an offshore jurisdiction, but for corporate law and tax purposes, it is considered as an Indian jurisdiction. So government has come up with this discussion paper on Indian SPACs, which is pretty much modeled on the US SPACs, where the same concepts of shareholder approval, at least 80% of the trust fund should be utilized for de-SPAC transaction, founders lock up for a certain period, shares and warrants. So everything is pretty much the same as the US SPACs. There is one requirement that at least the SPAC size has to be at least $50 million. So that's something which is there. Now, only thing from an Indian perspective is the government needs to iron out is because from an exchange control perspective, SPAC or rather gift city is an offshore jurisdiction. For Indian investors to invest in that SPAC, which will list, and interestingly, both NSE and BSE have floated their subsidiaries in Gift City. So these shares will be traded on those exchanges in Gift City. Obviously, the depth of the market and all those things, it will take time for to develop. But one of the concerns is for Indian investors to invest in that Gift City or rather a Gift City SPAC is going to be a question mark because for retail investors, the LRS limit of $250,000 would still come in because it's an offshore jurisdiction for Indian exchange control purposes. So that's something that the government needs to look at and iron out. But yes, otherwise, these regulations have been proposed. It's for discussion purposes and public comments. Hopefully in next couple of months, they will finalize some of these regulations for Gift City. And actually, Nishith and NDA have been quite active in discussing some of these things with the chairman of Gift City to actually make it more attractive for Indian business. It actually started with the Indian GPs who wanted to set up their funds in Gift City. But now the discussion has gone to the next level of even allowing Indian businesses to list in GIFT City. So I think maybe if Nishith, you want to just brief on that. But otherwise, it has been something that has been a new.
No, I think you summarized it well, actually. And, GIFT City whole idea came up when I went with Mr. Modi to Singapore in 2007. And for 10, 12 years, it was not moving fast forward. But the speed with which it is moving now, with the new chairman coming in, they are extremely active. And in fact, sometimes we had suggestions and discussion during the daytime, and at night they came out with notifications. So I think I would suggest people to just take a look at these papers if you have any suggestion. I think they are more than willing to mend the way, because this is mainly meant for foreign investors. Of course, to leverage that, they might liberalize some of the rules for Indian investors as well. But otherwise, they say that if the foreign investors are coming, they are willing to create environment in which they are comfortable with at this point in time, whether it is Hong Kong, Singapore, Dubai, New York, London, whatever it is, they say they would be happy to do that. So, but I think it's right that at the moment they are looking into this, and very soon we'll have a regime.
Great. Any other questions for?
Yeah, Ashish, can I ask? This is Vishal Jindal, Biryani by Kilo.
Go
So
ahead.
hi Ashish. I might have missed in the beginning, but can you give some examples of what size of startups or Indian businesses in terms of revenue or EBITDA and industries? Of course, you said e-mobility. What industries would be a right fit for the spec structure to get liquidity, revenue, EBITDA, and industry sectors? And are there in the last 3 months or the next 3-4 months some particular startups or companies in India who are looking at spec structure very seriously, so we can have an idea what is the right fit and what kind of companies should look for them?
Dhruv,
Dhruv or Ashish, you want to take up on the EBITDA and revenue numbers? I can maybe take up the other ones.
Sure. So in terms of, I wouldn't go based on EBITDA or revenue first. I would look at, where does it put you in terms of market cap when you're having a conversation with the SPAC founders? Because obviously EBITDA multiples, revenue multiples will vary depending on industry, depending on growth rates, etc. Right? But I think a rough rule of thumb to use at least is that you have north of $1 billion of pre-money market cap. So you've got some headroom to trade above that and be part of the indexes, be part of the portfolio of long-only investors. So that would be my rule of thumb. Again, as I said, we were below that threshold. We were around the 500 million mark at one point in time, and it's been a very difficult journey. It's also a costly journey because the compliance cost is high, fees are high, legal cost is high, audit cost is high. Everything on a relative basis does turn out to be higher for you as a listed company in the US. So my take at least is that you need to be north of $1 billion in terms of market cap or the transaction value before you consider going public in the US. That's just a rough rule of thumb. I mean, there's no real science behind it, but just looking at, trading volume, looking at, the kind of funds that you need to get in and provide stability to the stock price, that is like a basic rule of thumb.
Yeah. Again, I think from an industry perspective, we saw one renewable energy company, Renew, is getting listed. There is another SPAC listing which we are working on. It's a tech company, which will next couple of months you will hear news on that. But that already currently is north of $1 billion valuation. So that's something which is going to be a sizable one. But otherwise, the way I look at it is, ultimately SPAC is like a funding entity, right? So as long as like a private equity fund acquires Indian businesses or a SPAC acquires Indian business, at the end of the day, it is, funding entity. So in fact, we have been having conversations even with, in fact, I just day before yesterday, I had a conversation with a with an investment banker who had come with a SPAC founder who wants to set up a SPAC for an IBC type of situation under insolvency and bankruptcy code. If they acquire some company, can they do a de-SPAC transaction with that IBC, with a company which is in IBC, right? Because then there will be immediate gains depending on how much haircut they can negotiate with the lenders for the public shareholder of the SPAC. So there are, I would say, there is no one rule for this, but typically the traditional tech healthcare companies have always been, the favorites when it comes to SPACs. And in US, as I mentioned, e-mobility and some of those after Tesla and some of these other companies have got fantastic valuations. They have also benefited out of that.
I think the other thing I would just add is that you have to see if the company is also ready to go public.
Yeah.
Because being public is not the end of the road, right? An IPO is not the end of the journey. It's the start of a much more complex journey. So from the time you go public, literally in a matter of, let's say on average, 45 to 60 days, you will need to have quarterly financials out there and then be on the treadmill with those quarterly financials out every quarter within 45 days from close of the quarter end, right? So you need to be able to be in, as a company in a stage where you've got all these systems, processes, everything in place. You should also, I think, have predictability of business model, because investors will ask for guidance. They will ask, the analysts will spend time with you building out 2-3 year business models. So typically, I think there is a certain amount of predictability which would be needed. Now, there will always be the few exceptions which really right up there. They are household names. They might be businesses which today might be losing hundreds of millions of dollars, but there might be a path to profitability that they can show based on other, so taking an example of a Zomato. So hypothetically, you could have a Zomato scenario, because then you've got multiple others like that, like a DoorDash, for example, which are out there in the US, which are public, and there are benchmarks which have been set, right? So those exceptions will be there. But if you're a more middle of the road company, then you need to make sure that all these systems, processes, and everything else also you're ticking the box and you have predictability of earnings and business model.
Yeah, that's a huge point. Actually, the decision to go public is based on the maturity of your business, how strong your processes are, and also how predictable your financials are, so that you can give the right guidance in order for the market to get interested, right? I think that's a huge point. Uh, One nuance on the $1 billion, I think the $1 billion number is more from the point of view of compliance and getting larger investors interested. So it's not that, I mean, there are smaller SPACs who would be, let's say, 100 million. And with a 100 million SPAC, if you're a $250 million market cap or a $300 million market cap company, you can do that deal. But as Dhruv pointed out, I mean, IPO is not the end of the journey. It's the start of a new one. So you thereafter need to keep building interest in the various categories of investors, so that they keep getting interested and want to buy your stock. So that journey is a completely new one as compared to what most privately held companies have faced. So it's a very big shift from being private to going public. Any other questions? I know Ganesh, you had a question. Would you like to ask that, Ganesh?
Yeah, I can. So here in the US, we are thinking about it as IPO light, right? And the buzz has cooled off. Even folks like Chamath are having trouble with the uninvested money and so on. Now, what I'm wondering is, with all the additional regulation, taxes that some of the folks here astutely alluded to, is it still worthwhile? Is sort of the question.
Nishchal, you want to take that?
Yeah, I mean, I think each case has to be evaluated separately. I would say. So in fact, even for Renew, before we decided to do a SPAC transaction, obviously we had tried to do an Indian IPO, and we were also looking at the structures. But based on various discussions with the bankers, we decided that SPAC is the best way to get the company listed on Nasdaq. So I would say there is no one size fits all solution to this. It all depends on on uh, on the company. And again, I mean, it's a misnomer that it's a light IPO when the SPAC is set up, but when the de-SPAC transaction happens, there is a re-IPO, I would say, that happens because at that time you have to still go back to the SEC, file your form F4, where you have to give all the details of the target, including the financials as per IFRS, and so all that entire process you still have to go through, like in a traditional IPO at the time when there is a de-SPAC transaction. So I won't say that the benefit of lesser compliance on listing is the reason why you should go for a SPAC compared to a traditional IPO. I think it's more to do with the easy availability of capital right now from the SPACs. In fact, I was reading somewhere that in June 2020, almost $1.45 trillion of dry powder was there with the PE funds, and some of that is finding its way to SPACs because due to COVID for 9 months, hardly any investments had happened. So that is also actually fueling the SPAC mania. In addition to Trump, the election, US elections, where with traditional IPOs, no certainty on Trump versus Biden, that also forced people to look at the SPAC versus a traditional IPO. So I think it's all, I would say, you have to look at each and every company or situation differently, and then take a call.
Nishchal, this whole idea of IPO light reminds me of another category of listings in the US, which is around pink slip companies. The Chinese have exploited that route for couple of decades now, raised tens of billions of dollars, and those are usually much smaller listings with much lower compliance requirement. In fact, they are lighter than light. So, is there a reason why Indian companies don't tap that route?
One sec. So I pink slip. So I am not very familiar with that how it works. But is this something which is how is it different from a traditional IP or a SPAC structure?
Well,
These are like, maybe I can add a bit more on that. They're like OTC stocks, right? So over the counter traded stocks, right? As opposed to exchange traded stocks. But Ashish, typically for those, there is hardly any liquidity listing. So the challenge that you will face if you do something like that, it might get you the capital, but then it doesn't provide a path to exit to the existing shareholders because the turnover in them is very limited.
Yeah, I think it will be more like a paper listing, as I guess, may not be of too much.
And then migrate as they grow, they migrate to the main exchange, right?
Yeah, but then you have to really be able to get the interest. There is a lot of skepticism about why did you go through the OTC route as opposed to doing an IPO. You've been through very limited amount of scrutiny when you went public, so all of those challenges are there. So it's maybe versus an OTC listing on the US, I would think an AIM listing might be a better alternative for someone who's looking at maybe a lighter version of going public.
Agree, yeah. AIM or Canadian.
Also, I think reputation wise, at least what I understand, it's not something which is like it goes well with the reputation that you are pink slip listed company, right?
That's right. You're right.
Because it sounds like in Indian parlance, it's a chit fund type of thing, right? So it's highly risky also to trade, right? Some of these penny stocks. So I think as Dhruv rightly mentioned, AIM would be a better one. In Singapore, there is a separate regime for smaller companies for Singapore exchanges. So those would be better.
Yeah, micro exchanges, I think AIM, the Canadian exchange, and the Australian exchange stand out. Singapore is still too small. But,
Yeah.
Yeah. Great.
Yeah, quick point on the pink sheets and so on. Yeah, they have a bit of a checkered history. There's sort of it's considered sort of ersatz, right? So, a lot of the Chinese companies where some of them like Luckin Coffee and so on, right? High Flyer now, because of all the accounting issues and so on, trades on the pink now. But I think you folks mentioned governance, right? So when I think of companies like Infosys or HDFC and so on, if you have sort of the best governance, I think there's a lot of thirst here for now ESG, for good governance companies out of the emerging markets, right? So that would be wonderful if you folks can identify sort of a couple of, A+ governance companies. You're going to get huge multiples here. So I think the pecking order now is sort of the full IPO, then maybe SPACs, which have sort of lost their luster, but the direct listing is still, quite interesting, right? So there it is, no lockups and so on. So the VCs love it. And then the pink, obviously, you folks have sort of addressed the pros and cons. So that's how I sort of look at it, but happy to chat offline as well. I don't want to hog up the time here. Thank you.
Yeah. So interestingly, just one statement before Ashish, you close. Interestingly, in the month of January, I don't have the data for Feb and March, but just in the month of January, 131 SPACs got registered with SEC in 31 days.
Wow.
So almost 4.5 to 5 SPACs every day. So I don't know when this is it a fad and when it will end. I think nobody knows, but at least the fact that somebody is filing a prospectus with SEC, that means they have some interest from the investors.
You've got to grow your team multifold, Nishchal. So
actually, if you see very interestingly, that we believe in brain count, not in head count. Number one. And number two, if you see, our team is always the smallest. Our principle, we should do highest quality work in shortest possible time and with smallest teams. So if you see some of the I'm not judgmental, and please don't get me wrong, but we had only 4-5 people team. Of course, because for some reason there are a couple of more people, but otherwise 4, 5, 6 people. We have seen there are 22 people when we are the lead counsel. Some have 13, 14 people. So, if you have 22 people, I think we'll do at least 5 SPAC deal at a time. I'm just getting a lighter vein. So idea is that today our business model as law firm is so skewed that if you spend more time doing your job, if you put more people on the job, we are more rewarded. It's all time-based and stuff like that. And so we believe that that's not our model. Our model is that we should do, highest quality work, shortest possible time with smallest team. There's a small comment on expanding the team, and we are very careful in doing. So everyone is trained on what is called inverted T model. So everyone has 1 or 2 specialty, super specialization rather, and then they are generalist. So that base is general, and there is 1 or 2 super specialization. And third thing now we are working is horizontal edge. So there is horizontal line at the bottom, but new horizontal line on the top is that they are also good at management. So project management skills, the other kind of things that are needed so that you can accomplish. So they are all trained not only in technicals, but also on this kind of things. And then we can do a lot more. and hopefully we can add more value. People do appreciate that, and I think it's fun. I'm sorry I went a little long, but just coming back to your answer on expanding the team, yes, we have, but we have enough capacity. And with more experience, we won't begin to do more complex deals in lesser people, lesser time. Thank you.
Thank you, Nishith. If there are no more questions, then I'd just like to thank Nishith Bhai and Dhruv and Nishchal for the fantastic insights. I'm sure we'll hear a lot more about this route in the coming months and years as it gets more mature and perhaps more relevant for India. But stay tuned. And thank you very much, everyone, for joining. I look forward to our next session.
Great
Bye.
job, Ashish. Thank you so much for inviting us. And thank you on my behalf, of course, Nishchal, my firm, and Dhruv, wonderful to see you virtually. Hopefully, in the coming days, once lockdown is uplifted, we hope to see each other in person. Thank you.
Absolutely. Thank you. Thank you so
Thank
much,
you.
Ashish. I mean, just
Thank you, folks,
incidentally,
for your words of wisdom.
our structure was put in place by Nishith Bhai only 15, 16 years ago. So we thank him for his foresight back then to allow us to be able to do this. But pleasure seeing you again. Yeah.
Wonderful. Thank you.
Thank you.
Thank you.
Thank you. Thank
Where
you.
are you, Dhruv? In Mumbai or in Delhi or in Mauritius?
Delhi.
Okay.
Delhi.
All right. Catch up sometime. Thank you. Bye. Thank you, Ashish, once again. And thank you, Abhika. Thank you.